BMO analyst John Kim joins us right here on set. You've actually had some good picks in the past, too, John. So I just want to start off with what you're thinking about next year. Rates obviously been helpful, most recently especially. But you do say you were cautious this year. You're more bullish next year. Why?
Lower rates. I mean, interest rates are not the silver bullet for real estate, but certainly helps from an earnings and cost of capital perspective. It gives clarity on asset prices. And as a result, we think there's going to be more external growth. Companies will be more confident and have the ability to acquire more assets, and that's something that hasn't really been factored in the last couple years.
All right, so rates keep moving lower. These benefit, obviously, and there is going to be more purchases being made, perhaps, which we have not seen as well, I would assume. What parts, though? You know, we talk a lot about real estate, obviously, and then everybody wants to talk about office in particular and commercial, but it's only one part of it. I would assume office is still probably not a particularly good place to be?
We are actually positive on office.
You are?
It's
Why?
Controversial. There's still a lot of value in the office stocks. Some of the companies are now realizing that value through asset sales, through the conversion of office into other forms of real estate. A company, JBGS, for instance, in National Landing, has converted some of their office into an entertainment complex, getting the Nationals and Capitals in. Some conversions into multifamily. So there's a lot of hidden value that we're just not really placing much into the stocks today.
But even though rates are coming down, they're still a lot higher than they were when some of these deals went through. And are we still expecting a tsunami next year when they have to refinance?
The whole strategy of extend and pretend, it seemed like very risky, and it still is, but it could actually work. You know, if rates are going to come down, if we're seeing fundamentals get a little bit better, on top of that, supply is really coming off a lot in all sectors. Office, there's no new supply, but other sectors it's going to have over the next 3 years. The pretend and extend actually might work out, and you couldn't have said that 6 or.
No, although, I mean, for some of these things, particularly office, you're going to need equity coming in as well, though, new equity, because you're not getting a loan to value that's anything like what you had, right?
Right.
Is that there? Is that money going to be there?
Well, the REITs are relatively high levered, but they're capitalized pretty well, and they have great joint venture partners. And now we're starting to see investors from outside of the U.S. value some of this real estate, especially in the CBDs of New York, Washington D.C., San Francisco. They're starting to value some of this real estate, either for office or other use.
San Francisco's going to start to come around. I see that as one of your key points. Green shoots in San Francisco. Come on, what are you talking about?
He's calling a bottom.
We just have to say AI. You mention AI, and all of a sudden people get excited about San Francisco office. But that's where the AI growth is happening. So again, off of very, very low lows, they're much farther behind than Manhattan as far as the comeback of office space, and utilization. But green shoots are starting to emerge.
Although, finally, I mean, data centers, distribution centers, that's sort of a key area. Warehouses, that continues to be very strong, right?
Absolutely. The sectors that we are underweight are more consumer-driven, so multifamily. We will put hotels in that basket, retail. But most of the commercial real estate sectors we think will be very good next year.